Startup Secrets, where ideas take off.
90% of startups fail. Today, we uncover the secrets of why venture capitalist firms say no. Keep watching as we share tips on what investors look out for so you can turn your startup idea into a unicorn company. Now let's look at the first area VCs consider before saying no. Market-related reasons. 1. It's not big enough. VCs invest in huge firms. They aim for 100x and 1000x returns. The investor may like your idea but thinks the market will take time to recognize its value. You're establishing a good, sustainable business, but it's not venture scale. For example, you produce software for US-based entertainment lawyers who focus on celebrity endorsements and charge $100 per month SaaS. Even if you got all of them to sign up with no marketing and 100% margins, which you won't, you'd make $1.2 million per year. It's too small for a VC. 2. Too soon to market. The investor may like your idea but thinks the market will take time to recognize its value. Funding the company now will take a few checks until the world wants or needs the product. Even if the founders are visionaries and realize their idea would be large, how will they sustain expenses for 3+ years? 3. Established companies might accomplish it simply. Big organizations with several product lines, staff, and resources can swiftly develop startup-like items. Building something in Amazon, Google, or Facebook's roadmaps can scare VCs. It makes you an acquisition target, but most investors want you to build a large, sustainable business first. The second factor VCs consider before saying no is founder or team related. 1. Not mission-driven. They should care about the problem they're solving and have experienced it. This means the founders don't appear interested. They may mention making money, which is never the proper motive to establish a firm. Not even an excessively high pay will keep employees fighting during the startup's dark days. Or they plan to leave in a few years and don't regard this company as long-term. VCs have seen a number of blockchain for X pitches where the entrepreneurs don't have a strong reason for integrating blockchain, other than other people's excitement. 2. Red flags. When a founder is sexist, racist, disrespectful, or otherwise bad, they don't back them. VCs aren't interested in narcissistic people rambling about their bios for 45 minutes or sexist or racist viewpoints. VCs want to know if you can lead a team and create a safe, welcoming environment. They won't trust a bad person with their money. 3. Dishonesty. Investments are long-term relationships, so communication is key. If VCs believe founders lied, they're gone. Intellectual dishonesty occurs when founders aren't honest with themselves or investors about how things are going. They minimize issues and play up achievements, making it hard for investors to aid them and shocking when the company's true condition becomes obvious. Then there's founders lying about facts. Investors have seen overblown metrics, created advisors, and exaggerated product readiness. The third area VCs consider before saying no is fundraising related. 1. Poor presentation. This is another reason that VCs avoid mentioning, so just because you don't hear it doesn't imply it doesn't apply to you. Request that someone you trust be honest with you about your pitch deck. It doesn't have to be a design masterpiece, but distractingly awful decks make VCs fear that you don't prioritize aesthetics now and won't in your product later. Be exact and clear in your spelling, grammar, and legibility. Communication is essential. If you make blunders like these in your pitch deck, where you're trying to put your best foot forward, it signals you'll be even more sloppy with the rest of your business. 2. Pricing problems. If VCs think your valuation is too high, the high value means the VC will get less ownership for the same money, and you'll have to raise your next round at an even greater valuation. You'll need to reach many milestones and execute flawlessly, which is difficult. Depending on how much higher your projected valuation is than the VCs, you may appear overconfident and unrealistic. A low valuation shows a lack of financing, market, and product value sophistication. 3. Fundraising methods. The manner in which founders do their fundraising reveals a great deal about them. There is a narrow line between using psychological and sales strategies to maintain the interest of venture capitalists and being unethical. Saying you have numerous term sheets will inflame the competitive natures of venture capitalists, so avoid saying it if you don't. Attempting to generate scarcity or a sense of urgency when none exists is usually clear and can backfire. So remember, VCs would reject your startup for Market-related reasons your startup isn't big enough, it's ahead of its time, and if they think established companies might execute your idea easily. Additionally, they will show no interest if your founder or senior team members are not mission-driven, dishonest, or exhibit too many red flags. Finally, they will move on to the next startup if they foresee fundraising-related issues, specifically poor presentation, pricing problems, and your fundraising methods. Thank you so much for watching our video. Click the like button now to support our channel and click subscribe if you want to get notified each time we post a new video.